Well, hello and welcome to Business Television India. You're watching the Market Guru with me, Piyush Jain. Joining us today on the Market Guru is Jyoti Vaswani, the Chief Investment Officer at Future Generali India Life Insurance here. Ms. Vaswani, welcome to the show. Last time again we went to a conversation, perhaps markets were in a different mood, but at that time global cues were still looking quite robust here. Earnings or perhaps Dow, European markets, they still actually are looking robust, but a lot of cues have changed here. Rupee has suddenly depreciated by like a very swiftly, actually I should say, almost 68 now. And again, suddenly actually the market is turning optimistic on dollar, and perhaps we could be seeing 70. Again, those sort of euphoric comments have started to come by. We actually are looking at higher crude oil prices, Brent almost touching $80. So inflationary expectations are increasing. Very like 2 quarters down the line, worries around current account deficit. Now that's rising because you have higher crude oil prices, you have depreciating rupees. So again, that again comes back into fore. Question arises now, perhaps are we actually going to see a reversal of August 2017 interest rate cut? Can that also happen this year? So now, how's the entire setup looking to you? Because markets are still trading near life high levels. So where are we right now in terms of margin of safety? How good is the structure looking for the entire investment setup for the markets here?
So if you look at the Nifty, while that still appears to be at around 10,000, 10,700 odd levels, it's up 2% calendar year to date. But the mid-cap index, if you look at it, has fallen by nearly 9%, 10%. So the divergence between the Nifty and the mid-cap index is as high as 12%. So clearly the broad market has not participated in this recent rally that we have seen. So that's one. The other thing is about crude, as you mentioned. Yes, there's a significant impact of crude prices on India. Every $1 change in crude increases our current account deficit by 0.05%, and therefore if you have a $10 increase, it's like a 50 basis change in the current account deficit. So it could go all the way up from 2.1 to 2.6 just by a $10 current account deficit, and that's a significant number that we are talking about, and that clearly has its repercussions for the rupee. Now, talking about the rupee, I think it's more the rupee has depreciated significantly much more than the other emerging market currencies. So the dollar appreciation has been hardly 1 or 2% during the calendar year to date, but we have depreciated by as high as 6%. So clearly Indian currency has underperformed the other emerging market currencies so far, and that's largely, I think, due to the crude prices which have been going up, and also because of the foreign outflows that we are seeing.
Right.
So on the debt side, we've seen a $3 billion outflow so far. On the equity side, also we are seeing outflows which are happening. So clearly there is a pressure from that side, and therefore our currency has really underperformed.
So are we at present like ahead of the curve in terms of depreciation on rupee? Primarily, is the market already foreseeing the current account deficit or the outflows which we are seeing, or you think perhaps we are still in the middle of the way? Problems are going to increase again if there are no major inflows, and again if the crude prices continue to rise here. So is that going to worsen here, or currency around 68? We should be actually like starting to feel actually that perhaps stability is going to come now.
I think stability should start coming in now. You should see a lot of measures being taken. So RBI has taken some measures by allowing the debt investors, foreign debt investors, to invest short, and to ensure that the money doesn't really move out completely, and give them some incentive to remain in the country. So that's one of the measures that has been taken. So there would be measures which would be taken by the central bank to ensure that the currency does not really go beyond much beyond a certain level.
Is it also because the PSU banks are not participating, in fact, in a lot of bond auctions, in the government bond auctions? In fact, if I just remember the last 2 months, a lot of state government bond auctions actually have been cancelled here. In fact, more than 50% of the bond auctions have been cancelled, primarily because there was no demand here. So is it like something of government actually just thought if our banks, they don't want to come into the market because they are already facing M2M losses here, so we need more actually investors there, and that's actually they allowed them? So is that something which is going to work in favor, or maybe expectation that is going to work in favor here?
The expectation was, yes, that it would work in favor. But having said that, it is difficult to replace PSU banks. The sheer size and magnum of PSU investments is quite large, and they are a very critical, participant in the market. So while that would really help, but it would be more better if they are given some kind of, the bond yields have risen so much,
right,
and you need to take some measures to cool down the markets because they're getting overheated, and there's a lot of factors to it, of course, because you have the crude which has gone up, you have the rupee. So the rupee is also bringing imported inflation. The recent inflation numbers don't give you too much of comfort.
It's getting overheated. US yields are moving higher, crude oil prices are moving higher. I just want to ask you primarily because a lot of our viewers, again, they would be also getting actually slightly worried when they look at the screen here that perhaps yields are moving higher, crude oil prices are actually moving higher. Do you feel that bond yields have already priced in everything, or perhaps there is some risk that actually we could see some worsening in terms of yield trajectory here?
So if you look at the bond yields, they've gone up nearly 1.5% from the lows that we touched last year, and this is without any rate hike so far, right? So in anticipation that you would see a couple of rate hikes.
But now there's a huge gap between repo rate and yields.
Right. So there's a huge gap. So the point is that now that markets are starting to look at rate hikes, probably now you have talks of rate hikes happening this year itself, which some time back we thought would probably be at the end of the year. Now you might have, if a proactive, RBI preempt that and have some rate hikes this year itself. So with that, I think that is now getting priced in. So the second, leg of sell-off which has come post the last inflation numbers, and of course the US 10-year crossing the 3% threshold.
Right.
So if you look at the US 10-year, interestingly, so if you see, we've had one hike, Fed hike in 2015, we had one in 2016, we had 3 last year, 1 so far this year, another 2 expected this year, another 3 expected next year, and maybe another 2 in 2020. So that takes it to around 3.75 at the Fed level. So you are already at 3.10 on the US 10-year. So how much more can it go? Because you're talking of a US Fed yield, at 3.25 in 2020.
Right.
So there will be a time where it'll get capped because it really cannot keep rising so much. So I think that's something which, we need to take cognizance of, that at some point in time, US 10-year yield cannot, really push so much ahead of the anticipated Fed rate, 3 years down the line.
Right.
So that also we are reaching somewhere close to, the peaks as we kind of see it.
Right. So in that sense, then what actually are the main pointers or sort of main factors you're watching right now? Is it, and also I just don't want to be actually sounding too pessimistic here. What I also actually want to ask is that is crude really a worrisome factor, or perhaps this is it also actually creating opportunities for investing in stock like ONGC, Oil India, like oil producers as a theme in particular? Or actually you think perhaps markets where they are right now priced in around 18-19 times 1 year forward, this sort of trajectory perhaps can actually this also cause a valuation derating here. So is this creating more opportunities, or is it actually really creating signs of worry here?
So historically, if you look at it, when crude prices have gone up, markets have actually gone up. Okay, and so it's the risk on assets when they move together, and that's how it has been. The only differentiating factor this time around is probably the currency depreciation. So in those periods when the commodities moved up, the markets moved up. So it's typically a cycle where everything moves up. The currency had remained more or less stable. This time we have the currency also depreciating. So that's a differentiating factor. So we need to really see how it pans out. So crude obviously has an impact on fiscal deficit, right? Every $1 change in crude, so if we are expecting the government to participate in sharing the subsidy, right? If you can only raise prices that much without creating and with elections coming so close, it's going to be really difficult for, so there has to be some sharing. So far, the government has not cut excise duties and have not really participated in the, in this entire process. So if you take a 1 rupee excise cut on the crude, okay, that'll result in, say, we consume around 16,000 crore liters of fuel every year as a country, okay. So that's like, 1 rupee excise cut is 16,000 crores, and that's like, 10 basis of higher fiscal deficit, right? So that's going to be one impact. So if it's, we saw the excise duties hiked by around 7 rupees in 2015 odd, out of which 2 rupees has been cut last year,
right.
Okay. So you could still see a rupee or 2 cut before the elections, and obviously that's going to have some implications for the fiscal deficit numbers. Add to that the GST revenues, which we are yet to see the ramp up happening. So there could be some fiscal challenges for the government, and which is what is also worrying the bond markets as to, how, while they had reduced the borrowing number for the first half and for the full year by 50,000 crores, these are certain incremental factors which have come into foray, and that's something which is worrying the bond markets as well as to how things will shape up. The silver lining is that if GST revenues pick up and they actually cross, 1 lakh, 20, 30,000 crores per month, then you kind of, taking care of the issue. But that remains to be seen as to how things will really pan out.
But then, is this the reason why the market is getting so skewed right now? Because consumption suddenly actually is getting a lot more inflows, a lot more participation again. Most of the stocks are hitting life high levels there. If I look at the energy names, those are underperforming. At $80 crude also, ONGC is still trading where actually crude was at $60 per barrel. So no major sort of outperformance there. Oil marketing companies are actually at least 30% down. That could be more if I'm not actually at the mark in terms of price change here. So energy is underperforming for sure here, barring Reliance Industries, which again has a different sort of business exposure here. If you take a look at pharma, pure underperformance. Some stocks have rebounded, but again it becomes a very stock specific argument here. If you take a look at other sectors, perhaps infra, there has been a run up. If you bring banking again, it's only HDFC Bank, it's only Yes Bank and IndusInd Bank, and if I look beyond them, there is no outperformance here. It's like it's become so skewed. You really actually now have to think that if inflows are coming every month here, now where actually you're going to park money? That's my question to you is, you're getting money almost every month here. So where are you actually increasing your overweight stance? Where do you think perhaps it's better to be underweight here?
So let me start with the underweight, since we are talking of the energy sector. Clearly, there are concerns, on the oil marketing companies as far as how much they can pass on, and with the elections due at the end of the year again, how much they'll be able to raise prices, and therefore there could be a squeeze on their marketing margins. So that concern has brought the marketing companies at the levels that they are. Having said which, I think they've fallen so much that there is a value in that right now, right? So I think there's something that you could warrant a look at those prices. For the upstream companies, again, the concern is more on subsidy sharing as to, if the prices are not raised, then, who bears the, subsidy burden?
Right.
And the government can only take that much. So there could be a pressure coming on ONGC, and therefore the concerns on the upstream companies, which is coming through. And therefore the energy sector is not performing as much as it is.
So you remain underweight on the energy sector?
So we would remain underweight on the energy sector. But that's only on the OMCs and the upstream companies. We do like city gas distribution companies, and we do like the liquefied LNG companies. So there is a space where we are comfortable in that space. So selectively, I think every sector gives you opportunity to invest. It's just that you need to this is a stock pickers market,
right,
and you need to pick the right stocks in the right sector. So I think the other underweight sector for us would be telecom, where we are still seeing the competition really going aggressive as far as pricing is concerned, and therefore maybe the recovery is still a quarter or two away. So we are waiting and watching that space. We are also underweight on power, where a lot of problems in terms of SEBs and off-takes, etc. So we are still, underweight on that segment. Coming to the overweight segments, I think we are very bullish on the consumption theme in India, and we are playing the consumption, stories, and that would be both rural and urban. There's a whole lot of recovery which has happened in rural consumption over the last 1 year. So 2 years or 3 years back, it was an urban consumption story which was leading the recovery, and last year onwards, you're seeing the rural consumption story, which is really playing out well. And considering the focus of the government this year on rural infrastructure and rural economy, I think that's really going to play out well for the consumption stories. If the monsoon plays out well, I think that is only adding to it. And you have the MSPs, which will be increased for the Kharif crop, which would be a significant increase. So everything augurs well for the rural economy, and therefore all plays on consumption, right from FMCG to auto to your retail private banks,
To tiles and everything which supplies to rural infra.
Yes. So that's a theme that we are playing. We are also bullish on the infrastructure segment, while private capex is just showing some green shoots and not in anything in a big way. We're seeing green shoots in refineries. We're seeing big capacities being set up on the tire side, on the cement side. So there's a lot of some action beginning to happen there. It's not significant, significant enough to say that there is a huge recovery. The private capex is recovering, but there are green shoots. But the public infra space has been seeing momentum. The government has been investing significantly, and I think we're seeing a lot of action on the railways. Roads, we saw 7,400 kilometers being awarded. So there's a whole lot of activity on that side, and we are bullish on the infra space as well. So there's enough opportunity in the market, I think, to pick your stocks and have good investments.
But before I ask you a couple of themes again, because those themes are quite interesting here. One question again. Do you really feel a lot of these themes, they still have value? Like what we have priced in right now, 2019 or only 18, again that's already passed by, but 2019 or 2020, because even if we are talking about let's say tiles only, Kajaria Ceramics continues to scale new life high levels here. If you're talking about cement again, I'm just wondering where is UltraTech Cement going to go here? It's becoming so skewed and selective here. Even if you're talking about the rural sort of exposure, FMCG companies, all actually are rallying. So for our viewers again, for the retail viewers again who would be looking at the screen, and it's so valid theme of what you were talking about, monsoon, election time, rural sort of exposure here. So what the normal retail viewer again they should be now doing when they're picking out stocks here? Is the margin of safety adequate there? And perhaps what they should be prepared for? Is it 1 year of growth, 2 year of growth? Like what should be the patience time here?
See, the way India is structured, so we've seen a whole lot of structural changes in our country in the last 3 years, right? We've seen the GST, we've seen DeMon, we've seen RERA, we've seen IFZ. The bankruptcy code. You've seen a whole lot of important and structural changes in the country, the benefits of which will start coming only in the next 2 or 3 years, right? And therefore, we believe that in the medium term, long term, of course, we will do well, but immediately in the next 3 years, I think India is poised to grow very, very strongly. And you need to play that theme. You should not get, concerned about short-term aberrations. Right. This year is going to be volatile, and that's a given because
so the last year we have grown so much.
Yes.
Like the census
so
if
you have a 30% kind of return last year, you're going to have some volatility, and it's also driven by global cues because a lot of volatility happening because of what's happening in the US. Every other day you have a different Euro target coming from there. So yes, so it's a different market, and geopolitical situation is getting a little difficult. So clearly, volatility is going to be part of the markets this year. Having said which, I don't think we should get too worried by that. And if somebody is doing a systematic investment, they should obviously continue because this is a time you get to play on that volatility. Because over the next 3 years, I think equity as an asset class will significantly outperform, and that's my view. Because I think earnings growth. So what is the headwind for India currently? So we talked a whole lot of headwinds for India, but there are tailwinds as well. So we have economic growth. The GDP numbers are going to look good. We have corporate earnings growth, which has been eluding us for last so many years.
And also the credit growth is picking up.
And credit growth has started to pick up. So there are a whole lot of, and plus we have domestic liquidity. So while we say that the markets look a little difficult because foreigners are moving out, but it has really shaped. I mean, the way foreigners have been selling, the FIs have been selling, the market has held because there's enough domestic liquidity to take care of that kind of an outflow.
So if we have tailwinds, and the last actually answer gives me a theme here, and I want to ask you that is, asset management companies, is that theme which has been running since last 12 months here, is that looking very robust still on the valuation front, on the opportunity basis here? So I have the liberty of taking names here. So stocks like again Motilal Oswal or Edelweiss or IFL, we can include more names here, but I've just took 2-3 names here. Just to give examples for our viewers. Are the asset management companies looking robust as a platform? Like it could be L&T Finance also. And when I say that, I'm including insurance companies also in this basket. It is a different flavor, but it's a management of money here. Are they actually still a good sort of valid argument for investment right now?
So clearly there is a financialization of savings happening in India. We know that, right? So clearly, people are shifting from physical savings to financial savings, and who are the beneficiaries of that? It is largely these pockets, right? You have the beneficiaries are the asset management companies and the insurance companies. So clearly that's reflecting in their growth numbers, and we are seeing the kind of money that is coming. The insurance companies are doing well as well, and equally the asset management companies. NBFCs are also benefiting. So clearly, there is a NBFCs are benefiting more because of the market share gain that they are taking away from the
because they just
banks.
Don't want to grow, and it's like on a platter.
It's on a platter for them, and they're making good use of it. So the growth numbers on NBFCs will continue because clearly they're gaining the market share, and that value migration from especially the PSU banks to the NBFCs and private banks is clearly visible. So I think these are themes which will continue to play out.
So they still stand good actually.
That's right.
So in fact, stocks like Bajaj Finance, L&T Finance, they have been doing well here. But as I understand, Ms. Vaswani, please stay on with us as again we have to address now the Tata Steel earnings again. Those actually were quite strong. It was a strong show in the fourth quarter from Tata Steel. Nevertheless, again, European performance had been good. The managing director and CEO, TV Narendran, again, he spoke to BTVI's Priyanka Iyer. Listen in to what he had to say.
Overall, it was a decent quarter for us.